Look, my name's Chris Weston. I'm head of research at Pepperstone. Give you a bit of background, just before I sort of get going. I'm a market strategist. I've been a trader myself for about 20 odd years. There's a big difference between the two. Some of the worst traders known to man are market strategists. There's a big difference between making a set of assumptions and thinking where markets can go based on those assumptions being correct, and reacting to markets, managing risk, and actually trying to make money from the markets. What I want to do today is give you a bit of both, but more on the trading side. And my brief today was a 2024, or the rest of the year outlook, and enhance your trading game. To me, they're two very different factors, right? So I can talk to you about where I think markets may go for the rest of the year. I'm not sure if you're going to get huge benefit from that. And I can talk to you about how I see ways to improve your trading and how people are going about enhancing their trading game. So I'm going to spend a bit of time doing both. Hopefully you'll be able to see the difference in the two. I'm not sure if you can see that. Hopefully you can. I'll start with the outlook for the second half of the year. Now, outlooks do not benefit traders in any capacity, in my opinion. I think they're really important for multi-asset investors. If I tell you that I think there's going to be a 20% return in the S&P over the next 12 months, great. If you tell you that emerging market equities are going to do really well, fantastic. If I tell you that fixed income, the 10-year Treasury is going to return you, 8%, and you can work out when your expected returns are obviously really important in multi-asset portfolios. Go back to university and talk about the CAPM model and various factors. But for traders, they just create biases. If Goldman Sachs say they got a 6,000 target on the S&P, if a retail trader goes out and buys the S&P because of a 6,000 target, they're holding through drawdown, they're just blindly holding, and they're not really trading, they're just buy and hold. But it creates an emotional attachment, a bias that we don't really need to have. If we have a look at the markets at the moment, I'd say going into the end of the year, I think what's important, and where my understanding of being a strategist really can be quite helpful for trading, is understanding what the market's really interested in looking at. If you can define the exact points that the market's really focused on, you'll see the sensitivities around earnings for those specific releases far increased. The algos will react, the news recognizing algos that the high frequency guys are running will react more prominently to those certain data points, and you'll see the trend in the market sort of going along with the key thematics. And to be fair, if you have a look at the year-end price target for the S&P from most sell sides this year, beginning of the year, it's wildly wrong. So I think outlooks, when people say, what's the outlook, it really doesn't benefit traders in any capacity. Now I'm going to miss out. I've got the wrong slides here. Anyway, we go to the upcoming event risks that feed the narrative. Now, I think this is really important. The market catches on to a macro narrative, a key macro thematic, and you see markets kind of moving in alignment. Right? They all seem to sort of move as the macro narrative evolves. And right now, I'd say the two dominant thematics that we've got in the markets, pricing the probability of a slowdown in US growth, and a potential synchronized global growth slowdown as well. Fed rate cuts coming through, and the US election. These are the most dominant thematics. Now, Jerome Powell came out last week on Friday at the Jackson Hole Symposium, and he's changed the game. He's basically told us rate cuts are coming in September. The question is do they come out 25 or do they come out 50 basis points? What he's also done is he's reweighted and recalibrated the way that the Fed think about their importance of data. Before, it was very much skewed towards inflation. They've got a dual mandate, being inflation between 2 to 3% and also full employment. But they're now saying really big concerns about the potential of the labour market going forward. So the market is now far more sensitive to labour market data, and they will not be tolerant of higher unemployment rates going forward. So when we get inflation numbers coming through, we're going to react to it. Markets are going to be reacting to those numbers, but they're going to react far more importantly and far more intently to the non-farm payrolls numbers that come out on the 6th of September. If we see the unemployment rate staying at 4.3%, if we were to see unemployment numbers on the non-farms below 130, you know, you're going to see a big de-risking coming through. Markets are going to come out and say, right, it's on, the Fed had done 50 basis points, here we come. If it's in line, 25 basis points. But the market is looking at these central focuses. We get little bits of data which the market's saying that's a bit more important than the other ones. And, you know, we react and we just price in. That's what we do as traders. That's what we do as market participants. We price certainty. We price risk. And we know, when we know a little bit more about that macro situation, we can react and those situations play through. Let's have a look at what we're seeing there. I think the big one at the moment remains the slowdown that we're seeing in US growth. Okay? US growth is pretty good at the moment. It's not as bad as everyone says. We're probably running in Q3 around 3%. The labour market is cooling, but it's not collapsing. You know, durable goods the other day were at 9.9%, fine. But there's definitely a slowdown taking place. Inflation is running on CPI at about 1.6% on a 3-month annualised rate. It's coming down to target. The Fed have confidence that inflation's coming down to target. There's no need to have a Fed funds rate at 5.33%. They can bring it out of a restrictive territory and bring it back down to a more neutral capacity. Otherwise, there will be some problems going forward. Markets are saying the Fed are behind the curve. Now, that feeds into the point in the September non-farm payrolls number. If we do see a big weakening again coming through, the markets will say the Fed should have eased earlier. They're chasing, they need to be more urgent, and that continues to weigh on the US dollar, which is obviously weak at the moment. That continues to be a big trading thematic at the moment. For discretionary traders who are trading tactically around what's going on in the data flow, we continue to watch what's happened there, but it's going to be a much heavier skew towards what's going on in the labour market readings as opposed to 6 months ago when we were very much focused on CPI inflation, core PCE, and those various factors as well. Now, what's going to happen now is the second thematic which is going to take place. And that is the US election. Now, the problem for tactical traders and people running discretionary trading trades around the US election is a lot of people think about how the election will impact fiscal policy, potential changes in monetary policy further down the line, and market sentiment more broadly. It's how do you think it's going to happen? That's not the right way to think. The right way to think is how does the collective wisdom in the market, how is the aggregated flow of capital seeing the situation playing through? Now, if you look at the policies that I've sort of documented on the screen, these will change, and maybe there's going to be bits of nuances coming through. But, you know, I would say probably on balance that Trump's policies are more market-friendly than Kamala Harris's situation there as well. You know, I don't think Kamala Harris's policies are overly negative on markets. I mean, she's still campaigning. She's not exactly campaigning on fiscal austerity. You know, everyone says that Trump came out and spent loads of money and boosted the fiscal deficit, the government deficit. Well, in the first 3 years when he was in office, that wasn't the case. And we saw US debt to GDP running sort of around 105%, pretty much flatlining. And it was only when COVID came through that, you know, naturally we saw a massive spike in government spending, had to do it. But actually, the deficit under Kamala Harris, under Joe Biden, has been, you know, far more punchy. So there's no real situation to say that Trump is reckless with his spending. I don't think that's the case. But he is looking to roll over the 2017 Tax Cuts and Jobs Act, which could really boost the deficit going forward by something like $4.6 trillion over time. You know, he's talked about this idea about putting 60% tariffs on Chinese imports and a 10% blanket tariff on global imports. Now, that can be considered negative for risk and for equities, but it's not going to happen. There's no way in the world it's going to happen. Trump is he's a property mogul. He's chucked out his hardest bargain, and he'll walk it back. If we put 60% tariffs on Chinese imports, yeah, the Chinese economy would really struggle, and it would backfire significantly. So it's his opening gambit, and he'll walk it back significantly. If you go back to 2018 in the 2020 campaign, you know, he was talking about this idea about, you know, moving away from NAFTA, and every day we'd wake up and FX traders would see this 2% moves in dollar Mexican peso. You know, what happened in the reality was far different. So Donald Trump goes in hard. You know, the markets sort of de-risk a little bit and he walks it back, and when the outcome is actually far different from that. So I don't expect to see that really playing through. You know, he has also talked about a weaker US dollar, and JD Vance has come out with an even sort of more punchy view on that. We'll have to see if that has any merits at all. I think whoever becomes US Treasury Secretary is probably going to be the deciding factor on that. He's talked about lower corporate tax rates to 20%. Obviously, that's a positive for risk. Whether that happens is another thing. A lot of these factors really determined by the makeup of the Senate as well, and the makeup of Congress. You know, if we do see a Republican clean sweep, a lot of the sort of fiscal measures will be able to make it through very easily, or far more easily. If we see a split Congress, then some of this stuff won't get through. Anyway, so look, the bottom line here is, yeah, which of these measures are going to cause a risk-on thematic when we see the polls moving in one way? I would argue that probably the biggest situation for markets is actually the deregulation of US industries. I think that's the thing that the market will say, if it happens, that could be a big, big positive for US equities. We'll see if it happens. I think Trump promised that in 2016, and I think we actually saw higher regulation playing through. So it's really difficult to trade elections. You know, Harris has talked about lifting the corporate tax rate, considered a financial transaction tax, which obviously markets won't like. But we've got to understand how the market thinks as a collective rather than what I think, and what the weight of capital is going to do. For example, if we do see the polls widening out in favour of Trump, well, I suddenly go out and buy the US dollar against the Chinese yuan, the CNH, because of the tariff policies. You know, I think, oh yeah, the US dollar is going to rally against the Chinese yuan. It's an obvious consensus trade, like we saw in 2020 with the Mexican peso. But then the markets come out and say, well, you know, I'm going to go and sell dollar CNH because Trump wants a weaker US dollar. JD Vance wants a weaker US dollar. And he may even have a say in monetary policy, which I think will never happen, because if he does, the markets will go absolutely hard on Donald Trump because they want an independent Fed. So the fact is now I'm in a losing position. So it's not about what I think is going to happen. It's about what I think as a trader the collective wisdom will be doing, where the aggregated flow will be taking place. The other factor we need to consider is, when do we time these trades? You know, if I come out and see Donald Trump pulling ahead now, or Kamala Harris pulling ahead in the polls now, and I say, right, this is it. I'm going to express these election trades. Well, if I do it now, I'm still running up against US growth issues, or will the Fed cut by 50 basis points or 25 basis points? And that's the dominant thematic, and I'm fighting those cross currents as well. So the fact is, it's not easy. It's not easy to have these views. Oh, I've got no. So the way that I think about all of this situation is, I want to follow the flow in the market. I want to follow the aggregation of capital that's coming through. I want to become systematic in the way that I'm doing this. Retail traders lose money because they don't have a strategy, first of all. They're selling the dollar when it's strong, when it's weak. They're selling the US dollar when it's in an uptrend, and it's in a strong uptrend with momentum. They're buying the US dollar when it's in a downtrend, in strong momentum, because they think, yeah, it's got to turn, it's got to turn. And then when they apply leverage to that situation, yeah, suddenly next thing, they're managing a losing position, they get stopped out, they go again. It's got to turn, it's got to turn. You know, follow the flow. If you're trading short term, follow the flow of capital. That's the way I do it. But I think you can obviously have different strategies within that. You know, and I look at short volatility strategies and long volatility strategies. And when I'm talking about short volatility strategies, I'm talking about mean reversion, long-short strategies. I'm talking long volatility, momentum, trend following. And you can have diversification in those strategies. Now, the way to do that nowadays is through AI and ChatGPT and generative AI, right? Don't just go out and download a white paper and ask ChatGPT to say, right, show me the best momentum strategy out there. It's about having your own thoughts and testing a hypothesis. You know, until you actually understand how the system is working, you know, it's very difficult to know how this all goes about. So for me, it's about becoming systematic. It's about having a rules-based approach. If you go back to the 5th of August, there was a prime example of what we saw. You know, even people who had a trading system, which they were running systematic, maybe just through discretion or through placing it themselves, even everyone's discipline just blew out the water in that situation because markets were fast-paced. We had a VAR shock, essentially, and liquidity came out of the market and we saw it go down. People's systems blew up. And so I think that another reason is why retail lose money is because of emotion and their inability to think objectively, and irrational trading behaviours come into focus in that situation. So we need to understand how we can make money from a world of flow, okay? How people are reacting to these data points, how money's being moved around, whether we're trading momentum strategies, whether we're trading mean reversion, we're essentially trying to make money out of flows that are taking place in the market. And I think it makes you really understand what is actually happening and what's driving money. I think that's the most important situation. So, we get a situation where people come in the morning and go, oh, why is the Dow up? Why is the gold up? And I'm like, why is it up 2%? I'm like, well, there's no real reason. And they're like, what? There's got to be a reason. Well, it's not the case. Nowadays, the market structure, the people that we're trying to make money out of is changing by the day. Right? It's the people who are moving money around nowadays are the high-frequency trading funds. They're 70% of the S&P, 40% of the FX markets. These guys are in and out of positions doing multi-different strategies. We've got volatility dynamic funds in equity markets who are, whose level of allocation in the equity market is determined by the standard deviation of the market. If the volatility is going down, they're putting more money into the market. When volatility goes up, they're taking money out. We've got CTAs, trend-following, systematic trend-following funds that buy the markets when it's going up. These are opaque flows that only really the sell-side banks can be seeing. We certainly don't see those sort of business, but they're trading they're trading futures. But the market's going up, these guys are buying because their rules are telling them to do so. There's a whole multitude of trading flows that take place. Your zero DTE options, 50%, 50% of the daily options flows that are taking place. A lot of this stuff is just rules-based, it's passive, it's what we're trading, right? It's stuff that a lot of people have never even heard about. So when you see the market up 2% and it can't really be explained, it's just flow, and that's what we're trading, and that's what our trading system is trading, right? It doesn't have to be, oh, Jerome Powell said this, or Christopher Waller said this, or this person from the Bank of Japan said this. These are flows that are getting aggregated. That's what we're trading, okay? So learn to understand what is causing the move. I think it's quite powerful when you do, and you can create trading systems that just really take you out and your own personal approach out of the system and trade the flow of capital. Define your process, so it becomes systematic, as said, and then I think document and review your process. This is where ChatGPT now is where everyone needs to be, right? You're downloading your data, you're asking it, tell me how I'm performing over news, over certain days, first hour of trading. The future will be your phone will be your personal risk manager. It will be sitting there knowing my trading history and going, Chris, you typically don't trade well on the first hour of Monday morning in Aussie dollar, stay away from the market. Or you have a drawdown around non-farm payrolls numbers, stay around that. It knows my history, it knows my system, it knows my edge, and it can tell me what to do. That's not happening now, but it's not far off, I reckon. You could already download your history into ChatGPT and it tells you everything you need to know about your drawdown, where your edge is. And this is another point where retail traders don't go right. They don't know where their edge is. They don't know what their edge is, and they don't work on it. If you know something's working in trading, you do more of it. If something's not working, you do less of it. And you can't do that without documentation and reviewing a trade. And that's where ChatGPT and generative AI and machine learning is absolutely brilliant in that situation as well. So for me, the future of trading is about becoming systematic, becoming automated, taking the emotion out of trading, and knowing that what we're doing is trying to capitulate and make money in a market that is changing all the time. And the people moving money around are flow-based machines. It makes things very, very difficult.
Next up on the exchange stage.
Anyway, is there any questions?
Reimagining a new era of banking for businesses.
Go on.
Chris, thanks very much for that. I heard you chat about NVIDIA a couple of days ago on your thank you. Yeah, sorry. Chris, thanks again for the presentation. I was just saying I heard you chat a couple of days ago on your YouTube channel about NVIDIA and the upcoming results. I think it's Thursday, largely been influenced by a couple of those factors you spoke about. Has anything changed in the last week or so that would influence your decision on that?
Not really. I mean, I think, yeah, so NVIDIA report tomorrow at 6:20 in the morning, and, you know, I have no insight on where it's going to go. If I did, obviously, I'd be insider trading. But, you know, the thing with NVIDIA is that they'll beat expectations, they'll smash expectations, but we're always used to that. But the average beat is about $2 billion on revenue for the current quarter and the quarter ahead. I mean, they'll destroy it, they always do, but we're conditioned for them to do that. And the market positions itself above those numbers. So, you know, can they blow the lights out on gross margins, revenue, those factors? But the market is expecting a big move. The options market on the straddles are pricing in a move about 9.4%. So we could see, let's say it rallies 10% in the after hours, then you could see new highs coming through in the S&P tomorrow, essentially. You know, for me, it's about how you. I wouldn't want to trade the news because it's just such a punchy move, right? And you know, you've got to look at where the skew of risk is. Is it skewed one way or the other? And the options market can tell me that by looking at put volatility relative to call volatility. It can tell you where people are buying upside or downside protection, and that's pretty much, you know, pretty at an equilibrium level at the moment. So yeah, I don't know. I mean, all I want is movement in the Nasdaq, and I'll trade that. And NVIDIA will do that. That will spill over into the semis. It will spill over into the Qs, and it will fill over. And so, yeah, expecting some big moves. So the question for you is, do you want to be exposed to that? You know, do you want to reduce your position over that sort of news? And, you know, do you want to be involved when it could go either way? It's sort of a bit of a gamble, isn't it? But yeah, it's an exciting stock. It's a trader favourite. So one thing is assured is we're going to get some pretty punchy movement tomorrow. So put it on the radar. Yeah. Anyone else? All right, well, thank you for your time, everyone. Appreciate it.